Hello and welcome to another episode of Africa Builds with Nana and Olumoyewa. We are continuing our episode on Jumia and talking about Jumia Part 2, what happened after the IPO'd. To recap, we spent the first episode talking about Jumia, its founding from 2012 with the Samoa Brothers and Rocket Internet, the parts where Leo Stan had to play in both the Nigerian market and the Conga versus Jumia wars, how Jumia raised $700 million before IPO, and it seems the Nigerian economy and school fees was what the money was used for, and how they IPO'd just before COVID. So we are now going to be talking about a public company, Jumia. And just before we start, I think as a follow-up from the last episode, before we started recording this, I stumbled into one of those articles that made the waves that time in 2014. But this time, it was from a Jumia CEO, one of the CEOs in Morocco, who was actually responding to experts. His name was Bastian. And the article is still live today, where he said there's a reason Jumia is worth 1 billion and Conga is worth 35 million. And he analyzed both businesses. Of course, he's the CEO of a Jumia business and basically said, we know how to do this more than you guys. We know how to vertically integrate and learn how to run a business. You don't need to use xenophobia to inflate your valuation. I found that interesting because we spent the last episode talking about how everyone was writing on one side, but it's nice to see that same level of give and take was on the other side by the actual CEOs of the business. But over to you. Tell us what happened after the IPO.
Yes. So since we're doing articles we found from 2014 that were completely unexpected, I found a 2014 article on Tech Cabal written by Feyi Fawemi, and it's so interesting. I'll just read an excerpt from it. This is a tough business that is not for the faint of heart, and it should be sobering to people who like to talk up Nigeria's huge market. To be sure, there's a market there somewhere, but getting that market to deliver useful revenues and profits is a Herculean task indeed. In its 2 years of existence, only 360,000 people have bought something from the website. Is this the extent of the market? Most certainly not. But in a country of 170 million people with terrible infrastructure, more people should have been buying stuff online. The appeal of shopping on the internet is not just there, despite more and more Nigerians coming online. So if you look at the opinion of the professionals and you think about the fact that despite the opinion of the professionals, by the end of the day of April 12, 2019, Jumia was trading at almost $26, having first set the price at around $14. I feel like they must have printed out several of these kind of articles and must have been doing victory dances in their offices. And if you think about
They
it,
raised 200 million.
yes, they raised 200 million. And if you think about what this would have meant for the major investors, think about MTN, think about Millicom, think about Rocket Group itself. Although they had a lockup period of 6 months, but it suggested that they would get out with pretty significant money. One of the things you learn in Jumia's story is people will say it's like village people. Nothing ever quite just goes according to plan, except for the IPO. But everything else, there's always some complication in there.
Village people reading that excerpt from Feyi Fawemi, I think that may have been the first time this famous Nigerian quote was used in more academic terms, because the long and short of it is there is a gap in the market, but there was no market in the gap. And of course, that has now been used multiple times for any new type of business in Nigeria.
Does anyone know where that quote is actually from? I've heard it attributed to 2 or 3 different people.
It's been attributed to many popular Nigerian investors, but I think this is a more academic version of saying it.
Pretty much. So let me tell you about the first problem Jumia ran into. And in fact, one of the things I did when I was doing the research, and I felt it was such a clever pun, was how Jumia went left, was what I titled the document.
That's going to be your episode title.
Yeah. So everything was going well. At some point, the stock was trading at $50, which would have meant that Jumia was worth $3 billion. Again, this was a super, super loss-making company. Everything was pointing upwards and, to the right direction. But on the 19th day of its life as a public company, Andrew Left, who is a famous short seller, wrote a report about Jumia. Was not subtle at all. And I remember that the title of the report was All IPOs Are Not Created Equal. And then the second sentence was the hammer. Jumia is a fraud. I think we need to talk about Andrew Left because if we don't talk about Andrew Left, people don't have a lot of context into all of this. So do you want to maybe start with his conviction or short selling as a whole?
So short selling, if people have watched The Big Shorts and seen examples of Michael Burry on how he had that whole short on the housing market, there's the GameStop shorts, Roaring Katie and him invested in during COVID. Bill Ackman was also a famous short seller. So short sellers have kind of become financial celebrities in what they do, or financial gangsters, if you ask Elon Musk. The crux of it is these are another group of professionals that company runners hate, because they take a dedicated full analysis of the industry, of the market of a company, and make a position. Their position can be this is fraudulent. Their position could also be this company is overvalued and the price is too high. And that's in the case of Michael Burry, who everyone says has predicted 11 of the last two recessions, essentially calling every company a company to short. And Andrew Left was also one of the more famous names around at that time, because he kind of made it an academic exercise. Aside from these short sellers taking positions in businesses or in companies to profit off the drop in price, they actually publish research that makes for good reading. It's academic. People who write the ACCAs or ICANN or even the CFA are told to study some short selling reports to understand how markets move. And this guy was famous for Evergrande, Valiant, and a few companies before Jumia came along. So he had made his name in academic short selling, and it seemed like his next target was an African company. There was some bit of racism inside that was projected, but that's usually the name of the business. Everyone is mudslinging and trying to see what sticks, as long as the short seller has their facts. If anyone wants an entertaining version of short selling, they can also go watch The Big Shorts, Industry HBO, or Dumb Money. Those are entertaining versions of this. Over to you.
You said something that's mudslinging and seeing what sticks, which can feel really unfair for the company itself. And if you look at Andrew Left's entire career, he started with with a website called Stock Lemon before it became Citron, which is the more popular name. With even the Evergrande story, there was always the problem that some of the claims did not always stand up. He claimed that Evergrande was insolvent and that the company was hiding quite a lot of its debts and not disclosing it properly. What eventually happened was that the case was taken to the Market Conduct Board, and they found that on those two narrow claims, he did not provide proof that that was true. And they banned him from trading in Hong Kong for 5 years. Funny story is that Evergrande goes on to collapse in 2021.
Do you know that Evergrande's crisis also reached the Nigerian real estate markets? But that's also another segue.
They made some money, maybe 200 grand from the Evergrande thing, but was banned for 5 years and had to give back some of that money. Valiant really was where he made his name, because Valiant was a darling of the stock market. At some point, it had a market cap of 90 billion, and he published that report. Eventually, Valiant found that around, I think, $58 million of revenue that it booked were fictitious. So in a sense, there's that. So short sellers make money by essentially borrowing the stock. The entire thesis is if the stock price goes lower, they return the stock to who they borrowed it from and they profit off the difference. So maybe the stock is trading at $30. They publish a report, they take a short position. If it falls to maybe $10, they return the stock, they take the $20, they move on with their lives. So there's that. Let's get into a bit of the substance of the Jumia allegations, because I think that anyone who listened to the first episode must have seen this coming a mile away. You referred to it in the creative ways they defined certain metrics. But the key thing was that before Jumia went public, it had this presentation to investors in October, I believe. And it was a private presentation. No one knows where Left got the presentation from. But that presentation and Jumia's public filing, Left claimed that two key figures were different. That was really where all of these problems started from. If we look at the first set of problems, it was that first, it was about order cancellations. Jumia had said in the private presentation that around 41% of orders were cancelled or returned. You really have to think about this in that such a large number, which again, I think at some point we'll talk about cash on delivery and stuff. But if almost half your orders are returned or cancelled, I mean, what sort of business do you even have in the first place? Anyway, but in the public filing, what Jumia then said was that the cancellations and returns accounted for 14.4% of GMV. So Left's question was, there's a gap there. What's responsible for that gap? And he implied that the answer was fraud. And another part of why he implied that the answer was fraud was, remember we talked about sales agents, Jumia using physical sales agents very early on. It's formalized that process sometime in about 2016 and had a whole thing called J-Force. And what he then did was to pay commission to J-Force agents. But something that was interesting was it would pay commission not when the goods were actually sold. It will pay commissions on order received. You have to pay Jumia a commission if you sell on their platform. And then they would then pay a commission to their J-Force agents. The commissions they paid the agents were high. So it created sort of an incentive for fraud. At some point, there was a situation where employees of Jumia colluded with sellers, colluded with J-Force agents to take advantage of that arbitrage. So this is the substance of Left's claim that there's a difference between what Jumia told investors privately and the difference between what it filed, and that the only answer to that difference is fraud.
To put this in a cyclical way, like we said in the first episode, this was an example of the company is reporting GMV in a made-up number, even though cancellations are the bulk of it. And by them starting that process of manufacturing numbers or making up vanity metrics, every single player in that cycle now takes advantage of it. Jumia is reporting every single order made as GMV. And then when an order is made via a JForce agent, before the order is fulfilled, the JForce agent has already received their commission, which is costs to Jumia. And then somewhere along the line, the first order gets cancelled. Let's assume, for good faith, that that order was cancelled. In a normal way, you're not supposed to pay until the order is completed, or maybe ask the JForce agent for a refund. And when that doesn't happen, they discover they can now collude with sellers. First place an order, will cancel it. I get paid a commission. Jumia reports that as GMV, which eventually turns into revenue, and they stick it at the notes of the financial statements that this is order cancellation. And somewhere along the line, those two numbers don't match up anymore. And it becomes the core thesis of a short selling document 19 days after the IPO.
And it's so interesting now that we saw in May that Andrew Left was convicted of 12 counts of securities fraud. I believe he's going to appeal that judgment. If I think I read that somewhere. And if you then look at the Jumia thing, we see again a lot of throwing stuff at the wall to see what sticks. And here's what I mean. When you look at the comparison he did, you start to see that what he was comparing was a 2017 figure for percentage of cancelled orders. And then what Jumia disclosed in his filing was about 2018 figures, and that was as a percentage of GMV. So both figures did not quite match up. I think what had happened was he just got the sense that there's something afoot here, but he didn't have the clearest sense of it.
What did Jumia actually do to respond? Because usually what happens in these things is when the short seller publishes the first part of their piece, it may not be complete. They probably have incomplete information, but they have something. Sometimes they do it to also bait the subject. Depending on the response, they can either publish everything or go and do more research. So if you're saying that even his information was not fully clear, what did Jumia do in response to this?
Jumia did say that it would shed more light on it during its quarterly reporting, but also pointed out at the time that it had noted that there were some issues with its JForce agents, then said they were going to investigate the issue. That gap in when they were going to be able to respond thoroughly to the claims created a loss of confidence, as well as, to be fair, just Left being a big celebrity. And so we saw a situation where the share price fell almost immediately from $33 to somewhere along $24. And then, of course, in the Matt Levine way, where you say everything is securities fraud, we started to see class action lawsuits against Jumia claiming that it had committed securities fraud. That investigation into JForce actually happened. If I ask you today now that if you were going to create a payment incentive structure for agents, would you pay agents for just orders made? I need to understand.
I will pay them for completion
So what was the
and also
thinking here?
incentivize them to reduce cancellations.
So it's unclear what the incentive was. I wish we could find the people who designed the process in the first place to ask them, how could you not tell from the jump that this would be abused? So
Well, this is
anyway,
one of those things where, like we said about companies winning, we need to change that from bad behavior because we're not the arbiter of morality, but companies winning in the wrong ways, their incentive at that point in time was orders completed, which made up GMV. So if your orders completed is your incentive, you can keep making up the orders and canceling them on the back end. And you're showing investors that on Black Friday, we had 8 million orders. Don't talk about how many of those orders were canceled or fulfilled.
it's interesting that you say this. I'm not sure when listeners will get to hear this, but incentives are so powerful. We saw this week a business that cost operations, and what part of the reporting and part of some comments from investors suggested that the incentive was to just scale the business and grow with debt, because that created, or that will create, a better story for investors to make an investment. The investment did not come in and left the company in quite a bad place. So you're right. When the incentives are wrong, all sorts of bad things happen. Anyway, back to actual numbers. What did those numbers become when Jumia was able to say, this is what we found? What they found was that 1% of GMV in 2018 was commission payments. And many of those commission payments were just pure exploitation. So that meant, give or take, 8.3 million euros. Remember, for the longest time, they were reporting in euros. So that's 8.3 million euros 2018. And then another 2.4 million euros for the first quarter of 2019. That's what we see of the effect of that misconduct, give or take, if you do some math. But Jumia,
10
of
million
course,
to JForce agents in
thereabouts.
18 months.
So Jumia did say that it had virtually no impact on its financial statements. We don't know how much it is they paid. Again, just probably maybe rough estimates based on what they said, but they never quite said, this is this, this is that, this is that. They only ever said percentages of GMV. And if you calculate that, they said it had virtually no impact. I'm not quite sure. Maybe they were able to claw back some of the commissions. But what we know that happened for sure is that quite a lot of people lost their jobs as a result.
He said after this, there was also the class action laws. Did Andrew Left
Yes.
also publish any other? They normally make their short selling pieces a series. Was there another thing that was published, or did he just move on to the next company?
So the first thing that Jumia had to deal with was the class action. And when you look at it, what they eventually did was they settled out of court. I think they paid $5 million, but the impact had already happened. What's quite funny is that when we go further down the line, Andrew Left still published something else about Jumia that was pivotal to a brief rally in its prices. So hero and villain all in the same story. I don't think you see that in a lot of stories that you talk about. But anyway, one of the problems this created, the timing was really just bad for all the investors, because it meant that by the time that the major investors could sell down their holdings, Jumia's stock price was pretty low. So the lockup period expired by October of 2019. By April, all the connected investors had pretty much sold. All their major early investors, that's Rocket, MTN, Millicom. By April of 2020, most of them had sold pretty much all their shares. If you look at MTN, I saw that they brought in about $136 million in the share sale. And if you look at the investments, they never quite disclose how much they invested. But if you do some back of the napkin math, you're looking at maybe 250, 300 million. So not very good business.
So after this episode, how does the company move on? Still pre-COVID, October 2019, insiders have left. So how does the company move on?
The company is on the back foot. But when you're on the back foot this much, you have to start thinking on your feet and start to try to win back the trust of the market. The one cudgel that the market had constantly beaten Jumia over the head with was the fact that it was not profitable. So what did they start to do? As a public company, they looked at it and said, look, if we can show the public that we're a disciplined company, we can start to win some of the trust back. And it starts to inform quite a lot of the actions that Jumia did. Remember, we talk about incentives. When the incentives was to raise private money, what Jumia did was to say we're a Pan-African company. They had expanded to 14 countries. Expanding that fast in that period clearly means that there were situations where they had not thought through, is this company going to be what our time? Would the unit economics be great? All of that. But by 2019, it's on the back foot. It starts to make some rational decisions. It closed its operations in Cameroon, Tanzania, Rwanda. It shuts down Jumia Travel. And then by Q4 2019, we see the first full year report of Jumia as a public company. The co-CEOs, Jeremy Hodara and Sasha Poignonek, understanding the situation Jumia was in, had started to talk about moving towards break-even by 2020, which was a pretty bold claim considering how much they had been losing up until that point. You must now understand that what had probably happened was they're on the back foot, they're under pressure, they have to reassure the public, the market, that we can turn this around. And if you then look at their full year 2019 results, was not good at all. It did not suggest that break even would come in 2020 or thereabout when they promised. So yeah, that's how they moved on from that.
Speaking of the spin-offs, wasn't there a rumor or a brief scandal relating to the company that they sold one of those businesses to the
Yeah.
CEOs themselves and
Yes,
it made
yes,
news?
yes, yes. But again, one of the things that I find that people don't realize about the Andrew Left short seller report story is quite a number of the things. In fact, pretty much everything that Andrew Left pointed out, Jumia disclosed it. It's there. Jumia actually disclosed it. Whether or not it now provides sufficient explanation for their actions, different situation entirely. Now, to that thing, the substance of it was that they claimed that some parts of one of the business, I think it was called Jumia Facilities, was sold to one of the CEOs at €1 or thereabout, and that later down the line, the company then bought what was sold back from the CEO. So, like, what's happening in these transactions? Are they hiding something? Are they simply moving money around and they don't want you to know? So again, we see a common thing with Andrew Left here. Sometimes he doesn't know what the answer is. He's just sort of like poking holes and seeing what will stick.
I think maybe to also put some clarification on that one, because you said that they disclosed it. When companies are going on a roadshow or even on the market, they will publish their S1, or in Jumia's case, the F1, which is a 200-page or multiple page document. And they also put a presentation around with that. So the bankers and people who are curious can read those 200 pages, but when they are making presentations, usually the 8 to 12 page presentation that they stick to bury you with all the facts. So yes, you can hide anything in the S1. You just hope that someone doesn't read it. And in this case, he saw some things he was asking questions for because they had tried to bury it in the S1. That is usually also how these things work.
Imagine in this era of AI, I imagine it must be a lot more difficult to hide things in these filings, given that people can just feed them into LLMs and ask to check for stuff.
I think with the SpaceX IPO and the S1, it was mixed. I read it the old manual way, but you still have people posting on LinkedIn that the AI tools didn't find things they found the manual way. And there are lots of narratives. Depending on how good your bankers are, you can pump as many narratives as possible. So how many more narratives do you want to find to counter? Using the SpaceX example, we've been told that it's a term of 26 trillion. That's a big number that I can't start disputing with one line. It depends on your patience and storytelling. But thanks for that clarification. Where next are we going to with this story?
Let's look at their actual results for full year 2019. Revenue comes in at $160 million. Sorry, euros, because they're still reporting in euros at this point. 160 million euros, which, I mean, in normal circumstances, you would say that writer from 2014 was wrong. You could extract meaningful revenues from African e-commerce. But on the back of 160 million euros in revenue, its losses grew another 34% to 227.9 million euros. it meant that at this point, it was losing even more money than it was collecting. In the earnings call, I think of Q4 of that report, that was when they started saying all our quarterly reports from here on will be organized about talking about their progress towards break even. This is really when we see the business start to talk about gross profit after fulfillment, their losses per order, because for a long time, remember that Jumia was losing money on every delivery. So even on fulfillment, by the time it gets the goods to you, Jumia has made a loss. One of the key things they needed to do to improve that was to even start solving the problem of how do we ensure that when we've delivered the goods to the customer, we have made money from that transaction. And after it does that, it needs to then deal with the other parts of the expenses, which is the general and administrative expense, its technology expense, its sales expense. Because something that Jumia has constantly struggled with is that anytime it reduces its advertising and sales budget, it sees a commensurate fall in order volumes, in GMV, in revenue, which raises the question of, is this a sticky product? Will it forever need to spend so much money to generate only so much revenue to make quite a number of losses?
Something that stuck out to me as we were saying this is they made 160 million the first year as a public company out of 1.1 billion GMV. So essentially, this is a 6% margin business, depending on how they calculate GMV. They are no longer the Amazon of Africa, but Amazon is the template. I'm pretty much sure, probably correct this, but I'm pretty certain Amazon's margin on e-commerce is not 6%. What is actually making this 6%? Is it just expenses and tech and all that, or are they still burning money somewhere or doing some weird accounting?
For context, if we look at the numbers line by line, GMV grew by 38% 2019 to 894 million euros. So we see GMV really increasing. And then we also see, which might, here and there explain some of the problems. We see sales and advertising expense also reduced to around 9 million euros for that year. At this point, they had started reporting Jumia Pay total payment volume, which is something they really, really like. If you look at it line by line, where we start to see the problems with Jumia's business, I have the thing in front of me. Let me go through all of it. Their active customers throughout 2018, first quarter, 3 million, second quarter, 3.2, third quarter, 3.5, fourth quarter, 4 million customers. Now, they paid commissions of 2.8 million. So commissions really went up. This is when we also start to see marketplace revenue. Remember that Jumia had committed to becoming a marketplace pretty early in its existence. It had known for quite a while that this first party way of doing business was going to be too expensive. So
what's the marketplace in this instance?
They would allow other people list their products on Jumia, and then they'll take a commission for that. So it meant that they didn't have to commit money to buying products, to keeping inventory and all of that. And since they already had warehouses, they could even provide some warehousing services for the people placing goods on its platform. So if we look at it, marketplace revenue, 7.9 million, it paid commissions, it spent 2.3 million euros on fulfillment. Pretty almost the
That's
same.
delivery.
Yes, pretty much almost the same as commissions. Commissions and fulfillment, almost the same thing. And so when you look at all of that, what we now saw was that as a percentage of GMV, it was spending, for 2018, it spent 9.6 million euros on delivering these items. And then it spent 10 million on advertising. And then when you throw in its general and administrative expenses, Jumia's general and administrative expenses have historically always been high. If you throw in their technology expense, if you throw in, sometimes they will have share-based compensation and all of that, those are where the losses come from. So they've never really been able to dramatically trim their general and administrative expense. It's understandable. You have lots of employees and then you have pretty much expensive executives. I remember when Jeremy Hodara and Sacha Poignonek left their positions as co-CEO, I believe in November of 2022, thereabout, their salaries became public and the internet was puzzled for a bit. But what we know for sure is plenty expensive executives and large overhead because this is a business that requires hands.
You mentioned Jumia Pay for a second, and I remember there was a period just before COVID, but it blew up after COVID as well, where marketplace companies across the world and even Nigeria started selling that they were payments companies, even though payments was not their core competency. And everything you've mentioned now seems to satiate investor appetite. Is this a situation where the company was trying to sell any narrative to the market and see what works? There were a few articles. Jumia was always a company people love to write about, good times, where people analyze that it made sense for Jumia to spin off the Jumia Pay business as a standalone entity, that it could be worth 200 million, that the Jumia Pay business was, as a standalone entity, a better business to run than the Jumia marketplace. How are all these things happening? Because sometimes when all these things are happening at the same time, it's hard to piece the timeline together. What's happening here?
To answer your question directly, the answer is a bit of half and half. Here's what I mean. Jumia Pay, in a sense, was a response to a very real problem. In the first episode, we talked about payment on delivery quite a lot. A big part of that should simply have been cash on delivery. Jumia was collecting cash, like raw cash from customers. Again, you don't need a prophet to tell you where the problem is with this. In 2017 in Kenya, Jumia realized that there was around 720,000 euros that it had not been able to collect. Well, it was supposed to have collected it. The money would have changed hands, but the company itself did not collect it and was still trying to collect those monies as of 2018. You can imagine all the security issues it created. In a sense, it needed to solve that problem, one. Two, in talking to MasterCard, which later made an investment, the payment itself was a good talking point for what it could hope to achieve, how it could work with MasterCard, how this could be a strategic investment, and all of that. You have the pragmatic thing of this is a way to stop fraud. It also really coincided with fintechs becoming really sexy businesses. This is a company, remember, it's on the back foot. It needs every narrative improvement it can get. Once it realized what was happening people like this stuff, they started to really lean into it. The real proof you see that these things really did not matter in the grand scheme of things is that today Jumia no longer reports Jumia Pay TPV. It's not a metric that is particularly valuable to the company. But at the time, people just loved the idea. And when you really think about it, it would then say stuff like 15% of all the orders on Jumia are paid through Jumia Pay. The only thing I think that would have helped that narrative do, in practical terms, of course, was to assure shareholders that cash-related fraud is no longer happening. But the counterpoint to that was that by this time, even pay on delivery was no longer as cash heavy. At this time, pay on delivery is they are bringing a POS to your house in that sense, not cash changing hands. Also, this is something you can analyze. I remember what it had was some type of payment service license.
Service. Another narrative was we're not paying any other payments provider for offering this service. We're owning this in-house rather than pay an InterSwitch, a Paystack, or Flutterwave to process that money. You're processing it in-house, just anything to sell the efficiency narrative that we can also sell this payment service to other businesses. Konga also did the same thing. They were looking who can we sell this payment service to. But I find it interesting that even as a public company, at least they are now trying to be more mature and trying to make things stick. But how many things are they trying to do to make stick? And 2019 is almost over before we even get into COVID, because it sounds like you're saying they are experimenting by being a public company and COVID happens. Or was there any other experiment they ran before COVID? And what type of company does this become after COVID?
I don't remember a lot more experiments, but what is clear is the prong of their pitch to shareholders is we are becoming a disciplined, mature company. I think they want people to forget that the first year had quite a lot of stumbles. They are human beings. These things will happen, that kind of thing. And to then throw in a sexy distraction into the story of payments in the hope that the more we tell people that we can build this large payments business, this is at the time when we see VCs investing in fintech in Africa, that the perfect storm will happen and we'll move on. I think that the twist of fortune also goes both ways with Jumia, because sometimes too, they've had situations where they just received a helping hand where it might not have happened. If you remember COVID and the lockdowns, the general idea or the consensus was that COVID would accelerate shopping, accelerate online shopping. At this time, we had seen millions more Africans come online. People are home. It certainly must mean that Jumia is positioned to take advantage of this shift and make a lot of money. And guess who comes crawling out of the woodwork to solidify Jumia's narrative of this again? It's none other than Andrew Left, who now, instead of the short position, takes a long position on Jumia. Not only does he take a long position on Jumia, he believes that what's happening with Jumia in e-commerce means that in Africa, Jumia is the company that's most positioned to take advantage of a swell in e-commerce because of the lockdowns. And, we saw price rises. But one of the interesting things is COVID was not good for Jumia's business. Just
This
not
was
at all.
when their share price hit $65, right?
Yes, at some
And they
point
raised
in the
money.
year, yes, at some point up to 30 and 50 and 65.
So basically, all COVID stocks. Jumia was also a COVID stock, and they took advantage of it. Did they do anything important with this money still in the middle of COVID?
What they were able to do was, I think they realized their good fortune. The CEOs were even asked at some point if they would see an improvement thanks to COVID, and the CEOs were weirdly honest and they were like, nope, that's not going to happen. And true to it, if you look at their 2020 numbers, their GMV across all of 2020 was pretty much down across all the quarters. In Q1, 190 million euros, down 11%. Q2, 228 million euros, down 13%. Q3, 187 million euros, down 28%. Q4, 231 million euros, down 25%, which meant that full year GMV was 830 something million or so, against the 1.1 billion euros it did in 2019. Now, of course, revenue fell from 160 million euros to 139 million euros. To be fair to them, some of it was kind of deliberate. This was a period where they had started to talk about rebalancing their portfolio, wanting things that people are ordering a lot more. This is also where we see some of the thinking around Jumia Food and all of that. We see again a further reduction in their sales and advertising expense, and we see that in 2020 they spent 6 million euros on marketing. And which sounds like a lot, but if you think about the fact that they're in 11 countries as of 2020, they spent 6 million euros on marketing across 11 countries. Not quite sure that would have driven a ton of growth.
When did they start Jumia Food? COVID or pre-COVID?
Pre-COVID. Remember,
Let's just dive into Jumia Food then.
they had Hello Food from 2013.
That's also a Nigerian business or in another African market.
They had launched it in Nigeria. We talked in episode 1 about clones of several successful businesses. At some point, there was Jumia, which was the Amazon clone. There was Hello Food, which was the clone of only God knows what some food delivery
HelloFresh,
startup.
which they also owned.
Can you clone what? Yes, you can clone what you already have. There was Kamudi, which was car rentals, if I remember correctly. There was Lamudi, which was property rentals. There was something about jobs. They had a job thing. They had Temu, which was consumer to consumer type e-commerce. They had a listing thing too. It was just a lot of businesses. But by 2016, they had fused
All
everything.
those businesses were listed in the blog post the Moroccan CEO Bastian shared. I will just link it to the show notes with a whole presentation of verticals they were going into.
Food was a big priority for them because the idea was, look, someone buys a phone now, the person might not buy another phone for another 2 years. Someone buys a television. It's great for GMV, but it's not things that people are using often. While JumiaPay was part of that strategy to woo shareholders, the second prong of that strategy was, we need to do something that shows that Jumia is a place where people are buying things regularly. Again, they had to solve for stickiness, and food seemed like a good way to solve for that.
Something I want to call out now because you said that Jumia is unlucky and lucky at the same time. they went into splitting out the payments vertical or reporting the payments vertical in 2019. And it was rumored that the payments business was going to be worth 200 million. This was 2019. In 2020, Paystack got acquired for 200 million. Flutterwave became a $3 billion company. That's an example of them being early to the markets, but not taking advantage of it. And they launched the food delivery vertical or Jumia Food in 2019. This is before Global, before Chowdeck, who have seemed to run them out of the market. What is this a situation where they are also being affected by lack of focus or they are just unlucky?
That's such a difficult question. I published something when Jumia was facing pressure from Temu, the Chinese retailers, earlier in the year. And Adedeji Olowe's contention was that there are so many segments where Jumia has struggled, that somebody else has come in and eaten their lunch. For him, questions have to be asked about their execution. That's possible. But I also think that one way to balance the story is to remember that Jumia was super early to everything, super early. And this is one of those weird things where the first mover may not exactly have an advantage. The first mover will just burn insane amounts of money. We saw this with OPay and their customer acquisition. We saw how aggressive it was over such a long period. And despite that, and I mean, the business was growing like crazy, it still needed a black swan event in Nigeria deciding to change its currency and forcing a cash crunch to then deliver even the next wave of bigger growth. In that sense, I'll just say that they were too early. If you think about it now, for instance, some examples of the things people learned from Jumia and will probably not make those mistakes again. Today, if you look at Chowdeck, if you look at Glovo, if you even look at Swoop, they will charge you for the delivery. They will also charge a service fee. And the tendency is that we see those fees creep up every time. If you wanted to tell someone in 2019 that delivery and service fee for an item can run as much as 2,000, 3,000 naira, 3,500, in rare cases, maybe 4,000. How much food is the average person buying that they will be willing to spend 2,500, 3,000, 4,000 on the delivery alone? That's something that is worth considering. That at that time, people simply would not have paid truly cost-reflective delivery fees. People were not prepared to pay it. And remember, this was a time when QSRs like Chicken Republic were also expanding. At that time, you could see Chicken Republic around offices, around residential areas. This was a time where Booker Hut was also expanding as well. We saw a few new restaurants that were strategically opening locations around people's offices on the island, in Ikeja, in Surulere, clusters where they know that working people will buy from. If you think about it like that, you can't question execution. But if you ask the question of the current food delivery players profitable today, they'll say yes. But you and I know that except you're a public company, people define profitability very creatively. I don't know that you take that very seriously. But on the one hand, if we're going to be charitable to them, we'll be honest and say that they were just too early. Today, there's no pay on delivery for any of the food delivery companies in Nigeria. It doesn't exist. You pay with USSD card transfer. So there's no revenue loss in a rider running away with money. It's not happening. So just too early.
I remember the folks at Open Africa also said something like this on one of the episodes that they essentially taught the markets how to put their cards online and pay for stuff and taught the market to be comfortable with ordering food from random places on the internet. And they did not win that. What's happening? How did they move to a new CEO? How did they survive through COVID? How did they go through that? Since they didn't excel in COVID, what happened that they needed a new CEO and closing down all those satellite offices?
The co-CEOs were talking about cost discipline, progress towards break-even. And weirdly, I think that was the thing that doomed them because it then created this interest in Jumia's quarterly reports. Also, you have to realize that as far as startups go, this was the first time we could look at a startup and say, this is the claim they made. These are audited filings. And we can say, nope, this is a load of rubbish. People need to remember that. And how many startups today would be able to survive that kind of scrutiny, to constantly have to explain and defend themselves and their numbers and the way they do things. Even if we criticize them, we need to also put that on the balance of things. But that said, they talked a big game about break even. And I think for a lot of people, the idea was 2020 should take you towards break even better than before. They did not, although their losses narrowed a bit, but they did not take them towards break even. They were smart in that when the share price got to $30, $31, they sold more shares. They raised 243 million. In March 2021, the share price climbed again to around $39 or so. They raised another 341 million. That's from those sales when their share prices went up. They raised even more money than the 200 million-ish that they raised from the IPO itself, which means that by mid-2021, they were now sitting on like 600 million. When you sit on that kind of money, you must then ask yourself a question. Do we still commit to discipline, or do we become a startup again and start accelerating growth? Because what is the point of having all that money?
What did they do with all the money? We've essentially said that this is a historically, should I say undisciplined? No, but a company that knows how to throw money at problems and see if it works. And they're coming out of the post-COVID markets with 600 million in cash and a new vertical in food delivery. What did they do with this money?
They spent it.
I just realized I've asked this question multiple times and I had to find an answer in the last episode of what they did with the money. I am asking again, what did they do with this money?
They spent it. Because faced with that pile of cash, they decided to go on a growth acceleration strategy. You will think that they had learned from history, but that is exactly what they did. In doing a growth acceleration strategy, believe it or not, they expanded their first-party deliveries, which we know is a major cash burner. The SKUs from first-party increased from like 15,000 to 20,000. Remember I said that sales and advertising expenses had been dropped in 2019, dropped in 2020. In 2021, we were back to the Jumia that we always knew and loved before the IPO. They had spent 24 million on sales and advertising in just the third quarter of 2021. For context, in full year 2020, it didn't spend more than $10 or $12 million in sales and advertising expense. In one quarter in 2021, it spent $24 million on sales and advertising.
Is it possible that inflation and devaluation could have played a part in this? Because there was another devaluation of the naira in 2020 and in between. Like, is that possible?
No. Because remember, they raised this money in US. They sold these extra shares in the US. They are raising USD and spending USD. Where that will have an impact is in GMV figures. Because if you are selling in local currency and we've seen a devaluation, of course, we can then see all those effects. But in spending the money, you're still spending USD. So there's no real effect there. Basically, year on year, sales and advertising costs grew 200% plus. It starts to carry more product. It's spending on advertising. It's spending on marketing and all of that. And what this does, of course, is that if you throw money around a fair bit, you will get users. That's not very difficult. Q4 2021, it set records across board. 3.8 million quarterly active users, which was a record for them. 11.3 million orders, GMV of 330 million. And of course, the co-CEOs did a victory lap saying that the strategy that they were using was bearing fruit and, they'll do further investments in customer acquisition and education. This is important because we talked about the fact that a lot of this money was used to pay school fees. Even the CEOs acknowledged that some of this money was going towards customer education. Now, if you look at it, it then means that you know that the losses are coming. Brace up. It then means that for full year 2021, they lost $196 million in 2021, and their full year guidance for 2022 was a loss of between 200 to 220 million. Let's frame this properly. This company is 9 years old. It goes public 2 years ago. It hits a snag. That snag forces it to refocus. And then for 2 years, it tells shareholders that break-even and profitability will be the organizing principle of its existence. This same company is now losing money at an even larger pace, spending money like they can't spend it fast enough. The share price is under $10, and one of the co-CEOs was still telling TechCrunch that Jumia would deliver meaningful steps towards profitability, which remains the central objective. When you do full year guidance of a loss of 220 million and you tell people that profitability remains an organizing principle, you will be laughed out of by any right thinking person.
This is definitely when they sacked the CEOs, or they resigned and they had one CEO.
November 2022, both CEOs stepped down. Should we talk about the cloud that their salaries raised?
Where were their salaries raising? This is a multi-market company. It's nice to put that into context because the salaries was 4 million. Is the fact that the salary 4 million a problem for the African market or the US market or the
I think
European market?
it was just a Nigerian market thing. I don't think at that point people had an inkling of how much Jumia paid its CEOs. They didn't have any comparables. Remember, this is a first, and you have to be kind to people too. This is quite a first for a lot of people. So the idea that CEOs were earning that much was, it was just mind blowing. They each left with severances of $850,000 each. And their base salaries were around $480,000 plus another 4 million, like you said, in stock options. Lots of money. I think if it was not a loss making company,
They
people would
they were being paid European CEO salaries.
Yes, of
A
course.
European could say they were being underpaid.
Tell that to the Nigerian journalist who is like, oh, this is not a profitable company. But yeah.
What is the new CEO going to do differently now? And how, because this company is still making losses up till now. What is the new CEO doing different?
The organizing principle of this company is supposed to be break even and profitability. This is the thing that means the most to the board and the shareholders at this point of the business. The new CEO has to make some pretty difficult decisions. One of the things we saw happen before the new CEO came in as part of their drive to get more customers was that Jumia rebranded as this. Their tagline at that time was Jumia, your everyday delivered. Jumia wanted to be the place where you'd buy groceries, where you'd buy, odds and ends. The effect of that was that it was spending a lot of money to acquire customers whose basket size was very small. Of course, this would have depressed GMV and it had moved its focus from high ticket items. The new CEO comes in and has to make a lot of unpopular decisions. The jury is out because we want to know the person taking over, does the person really have the stomach to make the kind of unpopular decisions that Jumia needs? Or when faced with just enough money, would the person default to the usual? And like I said, we've seen this before. When the company suddenly had extra money, all they did was default to what they knew. To put it small context, at the end of 2021, Jumia still had liquidity position was 512 million and it would finish 2022 with 227 million. Remember, guidance for full year loss would be 220 million. They wanted someone who could really, really take hard decisions. In comes Francis Dufay, and as far as most people are concerned, probably will go down as one of the most consequential CEOs of Jumia.
He's going to trim, or he trimmed everything because we're in 2026 and it looks like he has trimmed everything. I think one of the more consequential decisions he has taken so far, before we even start going to the future, is the shutdown of Jumia Food. We've alluded that Jumia Food seemed to work in theory because we had to educate the market as well. That led to Chicken Republic and Domino's trying their own apps. There's Food Court, there's Glovo and Chowdeck as well, and now Swoop. I think there's a part of Francis Dufay saying when Jumia Food shut down that they left the market because of a well-funded competitor. The ironic part of this, for this our story, is that this well-funded competitor is Glovo. And do you know who the owner of Glovo is?
I think Glovo is the Spanish company, if I'm not wrong. Is Glovo the Spanish one?
Glovo is the Spanish company. Do you know who the owner of Glovo is?
Off the top of my head, no, but I feel like you say the answer now and it immediately comes to
Glovo
mind.
is owned by Delivery Hero, and Delivery Hero is a Rocket Internet Group company. Basically, we have a Rocket Internet CEO saying that he has been chased out of his home turf and a market that he spends time and money educating the markets on by another Rocket Internet CEO. And that is where we are on food delivery in that regard. So we're now in 2024. If we're trying to summarize this, you wrote the article last year and this year about Alipay, Temu, Shein, all these other Chinese competitors. And
Wait,
now
wait,
this is
wait.
what they are dealing with.
Let's not hurry away from Jumia Food. You know why I say let's not hurry away? Because I always think that Dufay's interview statement on closing Jumia Food tells us one thing about Dufay as a leader. This is somebody who just will say things as they are. And I think that's where we really start to see for the first time sort of like a Jumia CEO who is engaging with the difficult reality of where the business is and not where they hope that the business will go. And the line that gets quoted most from that statement is, of course, the competitors. But there's plenty other parts of it that I also find interesting. I'll read out that part to you. The more we focus on our physical goods business, the more we realize there's huge potential for Jumia to grow with a path to profitability. We must take the right decision and fully focus our management, our teams, and our capital resources to go after this opportunity. In the current context, it means leaving a business line which we believe does not offer the same upside potential, food delivery. This is someone who comes to the issue knowing that we have problems. And even before food delivery, something that tends to be glossed over a bit. Do you remember when we talked in episode 1 that Jumia was in Dubai, Jumia was in Germany, Jumia was, an African
Yes.
company, all these places it's in. Immediately, he became CEO in November. And I feel like this was a board level decision, to be honest, because it happened almost immediately he became CEO. Jumia had said it will move its leaders and decision making closer to the consumers and sellers in Africa. It reduced its Dubai operations, where quite a number of management functions were. Because of that, its headcount fell by more than 60%, and it relocated the team to African offices. And this is symbolic because it meant that this was the last cutting of the tie to how the business was run under the Rocket Internet company, that managing it from afar. And sort of why this might make sense is that Dufay, before he becomes CEO of Jumia, had been operating from Abidjan itself. He was CEO of Jumia Cote d'Ivoire, which I believe last year was one of their best performing markets, if I'm not wrong. But yeah, I wanted to add that.
Another parallel to this, which we touched on in the first episode, that Jumia being the one setting the standard of what everyone copies in the industries. It's funny that when he decides that all the executives or the board decides that everyone is going to move back to the continent, if you notice that timeline, that's also around the time Nigerian CEOs, founders, startups, that's the 2021 hot money period where it seems like Nigerian companies were being run from London and the US. It's another behavior Jumia popularized, and when they decided, okay, enough of this behavior, that is when Nigerian companies started doing the same. What else do you have for us?
Dufay, plenty big changes. The one that got quite covered a bit is that they started reducing their headcount. Remember that I said one of their stubbornest line items is their general and administrative expense. They had struggled for years to cut that down. Just a month or two into his time at CEO, they cut 20% of their workforce, 900 roles gone. And then they still said they were going to reduce even more in 2023. And as recently as March of 2026, it still said on an earnings call that it would cut roles even more. I think I wrote a newsletter at the Times making a joke of it that when job cuts are good news, because for a while, this is what Jumia's shareholders had wanted to hear. For quite a while, Jumia was subsidizing growth, subsidizing pretty much everything to just get customers into the door. Despite the fact that it had cut sales and marketing expense off and on, only to raise it again. This time under Dufay, we really saw a meaningful reduction. They said they were going to look at their online channels. They were going to audit all of that. I wrote a newsletter about one of their technology costs. And I believe there was a year where their cloud cost was about 14 million or thereabouts. They eventually ended up renegotiating that. So you could see, as far as CEOs go, Dufay is as reformist as it goes.
Okay. Okay, first of all, I'm trying to recover from the part where they've essentially laid off 3,000 people and counting since he became CEO. That's a lot of people.
Is it 3,000? Yeah, that's true. Yeah, yeah. Thereabouts. Wow, that's almost 3,000. Yes, you're correct.
That's a lot
That's
of people.
crazy.
I wonder what it would be like to be working there to have survived those number of layoffs. And the market is eating it up and they are renegotiating bills. Can we now go forward looking? Because just like when they started, Amazon and ASOS were on the continents and they have Temu, Shein, Alibaba to compete with, and even Amazon as well. And those ones also seem to be another group of companies benefiting from all the investments Jumia has made in educating the markets. They've exited the food delivery business for Glovo, Chowdeck, and now Soup. And all these cuts that the company is making, while it's nice that loss has gone down from 200 million to about 73 million, revenue has also gone down, and the cost of running the business, whether it's marketing or in headcounts, correlates with revenue, correlates with GMV. They're cutting everything. The losses are going down, but so is revenues. How is this company going to make do in a 2026 world? And I haven't even said AI. They have all these things to contend with, and AI hasn't even been thrown into the picture.
If all Dufay did was make these tough decisions and move on, we would have said, okay, they just had a reforming CEO, came in, made a few difficult changes. Maybe the next one will make a couple of changes. But I think where Dufay really earns his credit is how he responds to Temu, Shein, the Alibabas, and the competition they brought to the African market. Temu and Shein, for instance, at some point were spending something like $90 million advertising to African customers. It was clear that they really wanted to win. And what even sort of squeezed things a little bit more was we started having talks of tariffs. Of course, China had to diversify the places it was looking to supply and believe that, okay, there's a good market here. The customers have been educated. Let's just swoop in and win with low prices. And again, this was where people started to say, would Jumia now lose the core product it has built for these years to Chinese? And Francis Dufay always said they wouldn't lose. And the way they responded was interesting. The thing that Jumia had, or its most important things, were the fact that Jumia's delivery has gotten a lot faster. There are some items you buy on Jumia that if you order it on time, it gets to you the same day. Sometimes it gets to you
Yeah,
the day after.
I think that was actually, there was a period where this was also another piece of contention. I think your folks at Tech Cabal probably did this, but people used to run experiments. How quickly would it take to order something from Amazon and order it on Jumia? And most times, the Amazon order that came from outside of Nigeria arrived faster than the Jumia order that was allegedly from within the country.
They have fixed that, to be fair to them. Their deliveries are way faster, which again is always good for customers. Now they have trained customers to expect if I buy it within a reasonable period, it gets to me. That's on the one hand. And if you look at companies like Temu and Shein, you buy, it's going to take 2 weeks. It's going to take maybe 3 weeks. And so if the advantage is simply that the prices are cheaper or the assortment is wider, to be fair as well, then the solution to it is why a marketplace. Let's go there, build the contacts, get the sellers there to list here, list on the platform. We'll probably offer them lower commissions and we'll be fine. And that's exactly what they did. I don't know about the cross.
This is Jumia attracting the same sellers on Temu and Shein and AliExpress. Jumia went to go and recruit the same sellers on AliExpress, Shein, and
Exactly.
Temu.
So now it has warehouses in China. It has employees in China. The competitive response is pretty simple. If what people want is just a wider assortment and they are willing to wait 2 weeks, we can put all those same sellers on our platform. I think what also happened was it was always unsustainable for those companies to spend lots and lots of money. At some point, they would reduce their spending. I remember that when Timo came, I used Timo quite a bit. Now, not as much. It's very touch and go for me. I'm now open to checking Jumia or Konga or wherever. No allegiances or no first thoughts to here or there anymore.
Final question before we now go into looking forward analysis. The AI question. How does AI affect Jumia's core business? Not a business like Jumia, because most times how people have thought trends would affect a business like Jumia did not affect Jumia. What's Jumia's AI play? How does AI affect Jumia and the markets and even the CEO that seems to be doing the right things?
Jumia has not fleshed out its AI play, has not at least publicized its AI strategy. But one thing you notice is that I believe in their last earnings call, and I think I made a joke of it in their last earnings call, that I think they mentioned the word AI like 10 times, 12 times, but you hear AI quite a lot in that earnings call. And in fact, in that same earnings call, one of the reasons it says that it's going to trim its workforce by another 200 people is AI. Again, not a lot of details, but what they said was they're now running AI-driven workflows across their operations, logistics, finance, marketing. What that will allow them to do is to keep trimming headcount. Did I mention as well that under Dufay, they've also exited even more markets? They are no longer in South Africa. They are no longer in
They were in
Tunisia,
South
I believe.
Africa.
Yes, they were in South Africa. And I believe they are exiting Algeria or something.
Was this like how companies have a satellite office in South Africa or actual operations?
Hard to know, but I don't think it was never really a big business from what the numbers look like.
So how many markets are they in now?
I believe they're in 9 markets or thereabouts. I do know that they're in the process of exiting one market. Actually, let's do a count. Nigeria, Egypt, Morocco, Ivory Coast, Kenya, Senegal, Uganda, Ghana. I know that they are thinking about exiting Algeria. But yeah.
According to fake Google on their sites, which may be outdated, it's 8: Egypt, Ghana, Cote d'Ivoire, Kenya, Morocco, Nigeria, Senegal. Uganda is here surprisingly.
They exited Algeria in February 2026. Yes, 8 was the correct answer.
I find it surprising that Uganda is here.
But I know that from their last report, Cote d'Ivoire is a big market for them. Cote d'Ivoire
So
and
if
Egypt.
we had to now round this up or summarize the story, 2027, what's the plan for Jumia? As one of the analysts who also analyzes this business and is listening to the CEO, first one is the profitability goal going to happen? Are we going to record a Jumia Part 3 in the next 12 months to celebrate them being a profitable company? It's a very direct question.
Their target is break even for full year 2027, which means profitability would then be full year 2028. We have seen them make progress in reducing their losses. Let's look at the Dufay years. Before I get to an answer, let's just look at the Dufay years in terms of what the numbers show us. What we see with the Dufay years is that revenue has fluctuated, but the counterpoint to that is that the economy of some of these biggest markets have also really struggled. Nigeria has struggled immensely. Egypt within that period struggled. There were massive devaluations in both countries as well. You have that side of it to think about. What it meant for them was that from 2023, we could see revenues fall, we could see GMV fall a bit. 2024 revenues fell. And as the Nigerian economy starts to improve, or the macroeconomic conditions in Nigeria starts to improve, we see it making a difference in their business. In 2025, full year revenue was 188 million and number of customers 6 million. One of the things that you must still say they are struggling with is really growing their customer base. Because by the time he took over in 2022, they're at somewhere like 7 million customers. As of last year, they're at 6 million customers. But if you look at their losses reduced from 182 million in 2022 and last year came all the way down to just 50 million. Inside this business, break even is quite possible. Jumia is in a stronger position and definitely is delivering value to the people on its platform because it has raised the commission it collects from the sellers on its platform at my last count at least 3 times. What it really needs to do is that it really needs to keep onboarding sellers to its platform. One thing that Temu and Shein have really is just the diverse assortment. In 2025, like 90% of the items they sold were third-party items. That's always good. Dufay has accepted that moving towards profitability, towards break-even will require a smaller business. Moving towards profitability, I'm not sure a smaller business will yield that. They have 2 things they need to worry about. If the biggest markets by size, the Nigerian market, if the Nigerian economy meaningfully grows in the next 2 years, Jumia can become a profitable company. And here's
But
why.
a smaller company.
Yes, to be slightly smaller, but it will be profitable. That's one. Two is a criticism of Jumia that still remains relevant till today is that it's still a bit of an underwhelming experience to shop on Jumia. I'll tell you why I say that. Let's use an example of ASOS. Sometimes you go to ASOS and by season, the assortment is different. In spring, in winter, it's different. You can see that there's curation happening to make you get the sense that there's different things happening at different times. I don't think Jumia has been properly able to pull that off. That's one. Two, searching for products on Jumia. You open Jumia and search for a product. It remains a very big hit and miss. I think that these are the things that still I still make the experience of shopping on Jumia not as great. They need to grow their customer base. If still at this point in the business, in a market this large, they still have just 5 million customers, then it suggests that something in the experience in itself isn't working as much. Because one of the things that we see is even if you look at physical supermarkets, across all types of physical markets, some products will be cheaper. A supermarket can choose to offer lower pricing in maybe beverages or something. But in some other areas, the margins are then better. If anything, I think this is a time, especially now that Nigerians are price sensitive, if anything, Jumia can be a good place to compare prices and actually buy. If at the point where people are online, MTN's full year report shows us that even as the data cost has increased, Nigerians are using data like crazy. We're buying data subscriptions. It means that people are online. So why are we not using Jumia for the type of price comparison that translates into a transaction where you buy? I still feel like these are things that need to be. I mean, I'm online all the time and I still think I use Jumia maybe once a year. Sometimes I could go a whole year without using Jumia. There were times I would use Jumia a lot, but sometimes, like, I'll give you an example. Temu's experience for finding products on the app is just better, easier. Sometimes you just write high quality white shirts. You see like 100 listings. You can sort by relevance. You can sort by customer review. You can sort by material type. It always just makes for a better, cleaner shopping experience. And I don't think Jumia has gone in there.
You've actually now gone into the part where I wanted to do like analysis, but that's okay. And while you were doing that, I realized something that we didn't bring up and we had the opportunity to bring up multiple times. You mentioned about Jumia increasing prices for sellers, and we didn't mention another type of company that has come to eat Jumia's lunch, Instagram. WhatsApp, Meta as a company. So everyone is selling on Instagram and WhatsApp. And with payments now being a very mature products in Nigeria, it's easier and faster. There are also catalog companies like Catalog, Bumper, for example. Even Shopify, Nigerian businesses use Shopify, those that can afford it, to manage their storefronts. Essentially, these businesses would have been on Jumia. Some of them still maintain presence on Jumia, but that is another type of competitor that they are competing with on the seller side, and it's hard to measure and track that. So maybe to wrap this up in a bit, I want to ask, in our storytelling, almost 3 hours of storytelling, in these pivotal moments and with the spirit of hindsight, are there places Jumia could have made a different decision? Like, and we have pivotal moments like fighting, burning money on fighting with Conga, launching pay on delivery, even the food business as a whole, which seemed like a good idea. Like, could they have made a different decision in these three topics?
Yes. At the time they went to the market and had 600 million in the bank, at this point, where they then decide to say, let's get back into burning money again, I think is one of the most pivotal moments in the business. And I think that, again, Jumia suffers for being too early and also has suffered from the fact that the Nigerian market they came into is not that market anymore. Think about the fact that as early as 2013, Nigerians were shopping on ASOS. There were no custom charges. People were getting those items delivered here directly. Imagine that the economy continued and we saw per capita income continue to grow in that way. People are less picky. People are willing to shop online, all of that. When you think about it in that way, it's just, could they have done something differently? Definitely, I think everything up to IPO, I'll give that to them because private companies do private company stuff. spend money, try to grow at all means. But the minute they became a public company, I think that's when the game changed. I think they didn't make the adjustment quickly enough because they didn't realize how much of an uphill task that they had gotten. They were saying the words, but clearly you could see that they did not understand that the game had changed. They could not, during COVID, bring people online to shop. You have to think about it that we were all at home. Of course, it's different in Nigeria. We didn't receive a stimulus, but the reality is that people were at home. If at the peak of the pandemic, you cannot get your company to deliver everyday items, you say at that point you are Jumia everyday delivered. But at the height of the pandemic, you cannot get people to use you to get stuff delivered. I mean, questions then, of course, have to be asked about execution. In some of the early parts, there are big questions about execution. Big.
And then the food business, my own part on the food business is I can see how they launched and they tried to launch with the Chicken Republics and the Domino's Pizzas of Nigeria, the more established food brands. And when Glovo first and Chowdeck eventually launched, they went with the mom and pop shop on the streets, launching with those ones. It's almost as if they were also punished for ignoring that segment. It's also possible that that's the same judgment that they had with the number of sellers on Instagram, on WhatsApp, on Shopify, on Catalog, on Bumper. There are like many Nigerian versions of Shopify because of how expensive Shopify is. And when you see these businesses, I think when I interact with some of them or the people who are in these businesses, I'm wondering, why are these people not just selling on Jumia? Why did people need to go to Shopify and then look for a Shopify alternative when Shopify became too expensive? Is it possible that they have also, as a company, intentionally ignored those sellers that would probably have low baskets, or is it a pricing thing? Like, this is a very surprising disconnect from this company.
So two answers to that. On the food end, I would say arguably the most popular restaurant on many of these food delivery apps is Chicken Republic, 270 outlets. And if you go back to Jumia Food, HelloFresh years, I would say that Chicken Republic was still even rather early. If you really think about it, because I know that people will make it sound like plenty mom and pop shops. A lot of the volume on food delivery apps is driven by Chicken Republic. I would say displaced to a small extent. But if you think of Amoke Oge, which serves Amala, Amoke Oge is not your typical Amala joint. They have about 4 branches. There's that. And then if you think about clusters, like if you think about the Unilag cluster, if you think about Unilag, then you think about the fact that there's a lot of students there, Yaba, and then that area means that all of the restaurants serving students. Of course, today people have onboarded all of those people. But still, I'm sure that the growth, the volume numbers are still mostly the Chicken Republics and the Amokels. There's that on the one hand. If you look at the small business owners, in Nigeria, where starting a business is often a thing of survival. How many of these small business owners really ever scale and become massive businesses? My sense is that if the answer was a lot, we would not see a closure to things like, I believe that Flutterwave had a storefront. I believe that Paystack had a storefront as well. But I don't get the sense that we have a deep bench of small businesses. What we have is we have surface area. But as per depth, I don't think it's there on that level. And again, you have to think about how early they were. But as of today, for instance, you make a good point, though, that even if we argue that there's not a lot of depth for small businesses, but the question is, why are the most ambitious small businesses not using Jumia? Which is the bigger question. And then the answer will be something like, if I have a storefront, the storefront is almost free. Where the storefront mostly takes money from is the payments in itself. I can live with that. And then the question will then be that, is it that Jumia has not shown people that it can generate demand or generate sales for them? Because small businesses will flock to where there's guaranteed sales. Is it that they are not making the argument forcefully enough, or that people just don't see it?
Okay, that's clear. And just before we recap, when was the last time you used Jumia, or what was the last thing you bought on Jumia?
I used Jumia in maybe January to buy a fan or something. That's about it. And again, that's why I will
Have
still
you
say,
shopped online in the last 6 months?
yes, that's why I would say I still will. even as much as I tend to be positive about Jumia, that I still think there's a lot they need to do. For instance, I still shopped on Temu like 2 weeks ago. I wanted a white shirt and I'm like, I want to just see the highest quality option white shirts. And I just went in there and I just typed in high quality white shirts and I sorted from most expensive and I looked at it and I picked what I wanted to pick and I moved on with my life. I don't know why. Maybe the question is, why didn't Jumia come to mind? I wasn't just sure of what the process. I didn't want a situation where I go on the website and I'm now looking for stuff and I cannot find it, but yeah. But I think even before the end of this conversation, something I'll try to do so that I want to be sure that that has not changed is I'm actually going to go to Jumia and search and see if the search is still as wonky as I remember it.
All right, thank you. To recap this episode and close out, Jumia, a public company, went left because they were a victim of short sellers or a short selling thesis, and eventually they had to kill their JForce product because it was the origin of why they had contrasting GMV, revenue, commission numbers. And
no, they didn't kill their JForce product, actually. They didn't kill it. They refined it. What they did, the most important change they made was they now did this thing where they will only pay commissions on delivered orders and they will not pay it immediately. If that order gets cancelled or disputed, no payments there. Which made a
the
lot
more
of
we
sense.
talk about this thing, this is supposed to be a no-brainer. You don't need to be a genius to know that this is how to run a marketplace.
I don't know. Again, it would be great to be able to talk to some of the people who made some of the decisions. I don't understand it either.
They did not make the best of COVID as a company, despite that being a period when everyone expected them to make the best of. They lost the co-CEO model and closed down markets. They have a new CEO, Francis Dufay, who has been making tough and hard decisions as a leader. They were early to the food business in Nigeria, but they unfortunately lost that business to Chaldec and Glovo because of operational reasons as well. They missed out on the storefront market entirely. Your thesis is that we don't have enough numbers to make out on missing out on that. But when WhatsApp, Instagram, Shopify, Catalog, Bumper, and other companies seem to be attracting sellers, even Twitter or X seems to be attracting sellers, we need to ask, why did they miss out on the storefront model? And now for 2026, after they've laid off over 3,000 people in 3 years, they are now going to have to contend with competing with the Chinese behemoths in Temu, Alibaba, and Shein, and they have to answer an AI question. We don't know if we're going to record a part 3. You and Francis Dufay are promising that we will record a part 3 in 2028 when Jumia becomes profitable. Until then, thank you all for listening. As always, this is not financial, investment, or legal advice. This is strictly for entertainment purposes. Everything we have said here was researched from publicly available information, and we will try to link to as many of them as we possibly can. Please share your feedback, like, follow, comments, and all that nice stuff. Thank you very much.
What are we talking about next? Do people need to know what company is next? Because now we're wrapped up Jumia, and yeah, do we make any promises about cadence? When can they look out for us or not?
We'll make the promises on the websites instead of on the audio. And with that, bye everyone, and thanks for listening.
All right.